There's a siren song in the world of finance, isn't there? A whisper of uncorrelated returns, of diversification that finally breaks free from the predictable dance of stocks and bonds, alternatives. The very word conjures images of exclusivity, of a smarter, more discerning path to wealth. It's the allure of escaping the noise, of finding those hidden gems that the everyday investor might miss. We're drawn to the promise of something different, something that feels more robust. But here's where the critical eye, the data-driven mind, must sharpen its focus. The mainstream, often caught in the tide of popular narrative, can sometimes overlook the subtle, yet profound, risks woven into the fabric of these less regulated vehicles. Glossy brochures and aspirational stories can easily overshadow the quiet hum of potential pitfalls. It's a landscape where the usual guardrails are fewer, and the consequences of misjudgment can be far more significant. Our mandate, as data-driven investors, is clear: to look beyond the allure, to peel back the layers, and to demand rigorous due diligence. It's about understanding that true diversification isn't just about owning different asterisk types asterisk of assets, but about understanding the true asterisk nature asterisk of those assets and the risks they carry. As Benjamin Graham wisely cautioned in The Intelligent Investor, the investor's chief problem is never the market itself, but always himself. This principle extends profoundly to our pursuit of alternative investments. It's not just about market fluctuations, it's about our own internal biases, our desire for the next big thing, and our willingness to confront the hidden dangers that can exploit that very desire. In this exploration, we will not shy away from the uncomfortable truths. We will dissect three critical, data-backed risks that demand your unwavering attention before you even consider allocating capital to alternative assets. This is about building sustainable wealth, not chasing fleeting fancies. This is about informed decisions, grounded in reality, not just aspiration. The first hidden risk is the liquidity trap. In traditional markets, liquidity is often a given. You can buy and sell stocks and bonds with relative ease, the price reflecting immediate market sentiment. But with many alternative investments, like private equity, venture capital, or certain real estate funds, liquidity is a very different beast. You'll encounter lock-up periods where your capital is essentially frozen for years, and redemption gates, which can severely restrict your ability to withdraw funds even after the lockup expires. Consider what happens during a market downturn. While your publicly traded assets might be falling, you can at least see the value and, if necessary, sell them, perhaps at a loss. But with an illiquid alternative, you can't sell. You're locked in, unable to access your capital, even if an emergency arises or a better opportunity beckons. This isn't just an inconvenience, it can be a genuine hardship, turning what you thought was a liquid asset into a restrictive leash. There's a pervasive myth that alternatives offer diversification precisely because they are uncorrelated. While this holds true in stable times, a systemic shock can shatter that illusion. When markets broadly decline, even seemingly uncorrelated assets can fall in value, but the added burden of illiquidity means you can't escape the decline. You're stuck, and the inability to sell amplifies your losses. So, what's the data-driven approach here? First, honestly quantify your own liquidity needs. How much cash do you need readily accessible for emergencies and short-term goals? Second, meticulously scrutinize every fund document. Understand the precise terms of lockup periods and redemption gates. Don't just glance, dissect them, and finally, factor in the true cost of this illiquidity. It's not just about the potential for higher returns. It's about the opportunity cost and the risk of being unable to deploy capital when it matters most. Illiquid alternatives can feel like a gilded cage. They promise exclusivity and potential riches, but they can trap your capital when you need it most, transforming a supposed asset into a burdensome liability. The second significant hidden risk is the opaque fee structure. When you look at alternative investments, you'll often see terms like 2 and 20, a 2% management fee and a 20% performance fee, but this is just the tip of the iceberg. Beyond these headline figures lie performance fees calculated on complex bases, carried interest, organizational expenses, legal fees, and a host of other operational costs that can silently drain your returns. Imagine two hypothetical funds. One is a promising alternative investment, boasting impressive gross returns. The other is a well-diversified, transparently priced public market index fund. After accounting for the management fees, performance fees, and various hidden costs in the alternative fund, its net return can often lag significantly behind the index fund, even if its gross performance appeared superior. The fees, in essence, can eat away at the very alpha you were seeking. Furthermore, these complex fee structures can create misaligned incentives. Managers might be incentivized not necessarily to achieve the best long-term, sustainable returns for their investors, but to take on excessive risk or chase short-term gains that trigger performance fees. This creates a dynamic where the manager's interests aren't always perfectly aligned with yours, the long-term investor. Our data-driven action plan begins with demanding full transparency transparency. Don't accept vague promises. Insist on a clear breakdown of every single fee. Understand precisely how performance is calculated and what benchmarks are used. Compare the total expense ratio of these alternatives not just against each other, but against traditional liquid investment vehicles. Paying fees on alternative investments is akin to navigating a dense fog. You know the cost of passage is high, but the unseen currents and hidden shoals, the myriad of fees, can easily pull you off course, diminishing the ultimate reward of your journey. Our third critical risk lies in the realm of regulatory arbitrage and valuation uncertainty. Many alternative asset classes, by their very nature, operate with less regulatory oversight than traditional markets. Think about private equity, venture capital, or even certain cryptocurrencies. This reduced regulation, while sometimes cited as a pathway to innovation, also creates unique, systemic and idiosyncratic risks. The absence of stringent reporting requirements and investor protections means that the onus of diligence falls entirely on you, the investor. Consider the challenge of valuation in these spaces. Valuing a private company or a complex, liquid debt instrument is rarely a straightforward mark-to-market exercise where you can simply look at an exchange price. Instead, it often becomes a mark-to-model process. This introduces significant subjectivity, reliance on internal assumptions, and the potential for management bias or even manipulation to influence the perceived value of an asset. What looks like consistent growth on paper might be a carefully constructed illusion. There's a dangerous myth that complexity or exclusivity equates to superiority. Just because an investment is hard to understand or only accessible to a select few doesn't automatically make it a better choice. Often, this complexity simply masks a lack of demonstrable underlying value or, more worryingly, an abundance of unmanaged risk. The allure of sophistication can blind us to fundamental flaws. As data-driven investors, our action plan here involves diligent research into the regulatory environment of any alternative asset class you consider. Understand the rules of the game, or more importantly, the absence of them. Thoroughly investigate the valuation methodologies employed. Are they sound? Are they transparent? Where possible, seek independent, objective third-party analysis to corroborate internal valuations. Investing in largely unregulated alternatives without understanding the rules is akin to playing poker without knowing the hand rankings. You might get lucky for a while, but the odds are fundamentally stacked against you, and the house, or in this case, the lack of oversight, always holds a significant edge. Beyond the structural and regulatory risks, we must confront the behavioral trap. This is where our own psychology can lead us astray, particularly when it comes to alternative investments. The fear of missing out, or FOMO, is a powerful driver. We see headlines about astronomical returns in private equity, venture capital, or emerging digital assets, and we worry we're leaving untold wealth on the table by sticking to more traditional, perhaps less exciting, investments. This is amplified by the allure of exclusivity, the idea that we're part of a select group privy to superior opportunities. There's also a sophistication bias at play, where we tend to trust complex instruments over simpler ones, believing that complexity must equate to greater intelligence or better outcomes. History offers stark examples. Think of the lead-up to the 2008 financial crisis. Many investors poured capital into complex mortgage-backed securities, blinded by the promise of diversification and high yields. They trusted the perceived sophistication of these instruments, overlooking the profound underlying structural risks that ultimately led to a global financial meltdown. The narrative of uncorrelated returns, so appealing in theory, evaporated when systemic risk materialized. We must challenge this narrative relentlessly. The diversification benefit that alternatives supposedly offer often vanishes precisely when it's needed most. During periods of market stress, when the unexpected occurs, these assets can suddenly become highly correlated, leaving investors exposed to concentrated, amplified losses, not the intended diversification. Our data-driven action plan here involves a rigorous pre-mortem analysis. Before committing capital to any alternative investment, ask, what could possibly go wrong? And critically, how would those potential failures impact my overall portfolio? Develop a clear, data-backed investment thesis for why this specific alternative investment is appropriate for your goals, and then stick to it. Resist the siren song of hype. Chasing uncorrelated returns in alternatives without understanding their hidden risks is like a sailor charting a course based on a beautiful but ultimately inaccurate map. The destination might seem alluring, but the journey is fraught with unseen dangers that can easily lead to shipwreck. We've explored the hidden liquidity traps, the opaque fee structures, the regulatory uncertainties, and the behavioral biases that can ensnare investors in the alternative asset space. Now, let's bring it back to building a truly resilient portfolio. It's crucial to understand that alternatives are rarely a replacement for your core assets like well-understood equities and bonds. Instead, they can, if risk thoroughly understood and carefully chosen, be a considered addition for very specific risk and return objectives. The question then becomes, what is the appropriate allocation? A data-driven approach here means moving beyond aspirational percentages and focusing on your individual risk tolerance and long-term financial goals. For most investors, this might mean a relatively small, carefully vetted portion of the portfolio rather than a wholesale embrace. It requires a deep dive into your own financial landscape before even considering the landscape of alternatives. Here lies a contrarian view. True diversification doesn't come merely from owning different things. It comes from understanding how those assets behave under various market conditions, especially during periods of stress. Many alternative investments, despite their supposed uncorrelated nature, fail this critical test, collapsing alongside traditional markets when stability is most needed. Our final data-driven action plan is therefore one of intense focus. Prioritize robust due diligence above all else. Understand your exit strategy thoroughly. How and when can you realistically convert this asset back into usable capital? And always ask yourself, is this alternative asset truly enhancing my portfolio's risk-adjusted returns? Or is it merely adding complexity, hidden costs, and unacknowledged risk? As Warren Buffett might imply, it's far better to own a well-understood asset that performs as expected in adverse conditions than a seemingly diversifying alternative that collapses precisely when you need it most. True resilience is built on clarity, not complexity. We've journeyed through the often seductive world of alternative investments, peeling back the layers to reveal the hidden risks that lie beneath the surface. We've confronted the specter of liquidity traps, where your capital can become ensnared for years, and the silent drain of opaque fee structures that erode returns before they even materialize. We've navigated the murky waters of regulatory arbitrage and valuation uncertainty, where complexity too often masks a lack of substance. And we've acknowledged the behavioral biases that can lead us, like sailors charting a faulty course, towards financial peril. Our journey has reinforced the core ethos of the data-driven investor, a healthy skepticism, an unwavering commitment to rigorous analysis, and a profound understanding of risk before chasing reward. It's about recognizing that true diversification isn't just about owning different assets. It's about owning assets that behave predictably and resiliently, especially when the broader market is in turmoil. The critical question you must always ask yourself before even considering an alternative investment is this: does this specific opportunity genuinely improve my portfolio's risk-adjusted return profile, or is it merely a complex, costly distraction? Is it a tool that enhances your financial resilience, or a siren song leading you toward vulnerability? Benjamin Graham, the father of value investing, taught us the paramount importance of seeking a margin of safety. For traditional investments, this margin is found in buying assets below their intrinsic value. For alternatives, this margin is built differently through exhaustive due diligence, a deep understanding of their unique and often hidden risks, and an honest assessment of their true place within your overall financial architecture. Alternatives are tools, not magic wands. They can be valuable additions to a well-constructed portfolio, but only when their intricacies are fully grasped and their potential downsides rigorously accounted for. Empower yourself with knowledge. Apply this critical, data-driven lens to every alternative investment opportunity you encounter. Ensure your pursuit of diversification doesn't inadvertently lead to financial vulnerability. The path to sustainable wealth is paved with informed decisions, not blind faith in complexity.